Well, time now for today's topic. Since the emergency rescue of the US hedge fund, long-term capital management, there has been increasingly heated debate about the role such funds play in the global economy and whether they should be more stringently regulated. In a moment, we'll be talking to Beverly Chandler, author of Investing with the Hedge Fund Giants. But first, this report from Chris Burns.
The term hedge fund has become a catch-all to describe specialist investment funds offering high risk, high returns. But there are more than a few hedge fund practitioners who argue this isn't an accurate picture. There are estimated to be somewhere in the region of 3,000 hedge funds worldwide, and they fall into three broad categories. The first is low-risk funds, which are more or less market neutral. They go long or buy stocks which they think will go up, and they short or borrow and sell stocks they think will go down, hoping to buy them cheaper later. Whichever way the market moves, such a fund is covered. Some would argue this is the original definition of hedging. Then there are the hybrid funds, which buy long and sell short in equities and also speculate in bond and currency markets. The best-known examples of this type are Soros Fund Management and Tiger Management. Finally, there are the hedge funds, which some argue aren't hedge funds at all, but quasi-banks. They hold assets against their liabilities and equity. The assets include all investments made with the partner's capital, plus investments made using leverage, arranged by financial counterparties, usually the major investment banks. LTCM falls into this category, and it was said to be leveraged at a level of 300 to 1. So some hedge fund managers argue that the perception all hedge funds are high risk is wrong.
Managers such as global macro fund managers take leveraged directional positions in markets. They look to profit from macroeconomic shifts in policy and do not necessarily hedge out risk. But then you have your manager, your convertible bond arbitrage manager, who's in his fifth or sixth or seventh consecutive year of mid-teen results. And he has not deviated from his strategy. He is seeking to produce stable, consistent returns and is not aiming for magnitude of returns at all.
While there's a growing expectation that tougher regulation for the likes of hedge funds like LTCM is inevitable, some in the industry believe regulation of all hedge funds would be misguided.
The main difference between hedge funds and mutual funds or unit trusts is that mutual funds and unit trusts are regulated, and the regulation acts as handcuffs, because in a down market, a mutual fund cannot take the necessary or adequate protection. For example, we compare a unit trust to a cork floating on the ocean. As the market goes up or the waves go up, the cork and the unit trust go up. When the waves go down, when the market goes down, the unit trust will go down. But a true hedge fund is like a submarine, traveling just underneath the wave action, almost in a straight line, irrespective of the action of the wave.
In the 1980s, the high-yield corporate bond was turned into a term of abuse, junk bond. Yet it was such bonds which helped create the likes of MCI, CNN, and News Corp. Now, in the late 1990s, the term hedge fund is in danger of being treated likewise. And the hedge fund industry is warning that would do a great disservice to a sector which was designed to protect against risk, not create greater risk. Chris Burns, CNBC.